Hello. Today we'll look at the difference between saving and investing. In everyday language, people tend to refer to their money in the bank, mainly in a current account or a fixed deposit, as an investment, but it is more like a savings. However, it is also common for people to refer to their long-term investments, such as their retirement account, as having some savings for a specific purpose. Both concepts are related to the desire to live more stably and better, so it's basically not a big mistake to mix them up. They both start from the fact that make a budget, maybe it is made just in your head, you know what you live on, you know what your expenses are and what your income is, and you don't live off some of it, but you save some of it for later. Regardless of that, or because of that, it's good to be clear. Let's look at what the two concepts mean and which one you need when. Let's start with savings. Savings are income that you do not spend. Yes, in case of investing you do spend it, and you use it to buy an investment, but we'll discuss that later. Surplus income is usually kept in a bank account by most people. But you can also save it as cash in a piggy bank. You typically do this for a later goal. For example, to save up for a payment that is due later but is already visible. This payable, although within a foreseeable time frame, exceeds the amount you can cover from your regular income. So if you manage your money well, you can use the savings for a purpose within the year. But don't keep your money in a bank account for a long time, because inflation can reduce its purchasing power, but the bank will invest your money and make a profit for themselves. If you've been saving for years, invest it so that it accumulates sooner. Later spending within the year can be, for example, to cover future planned expenses. This could be a car insurance, servicing, or even the start of school. Savings can also be useful for loan repayments, if you want to use 1 or 2 monthly installments a year for early repayments and thus pay off the total loan debt sooner. But it can also be useful if your income is not completely fixed, but seasonal. Then what is easy to pay one month may be very difficult to pay the next. So when you're doing well, you can save for a leaner month. The bank also prefers this approach. If something really goes wrong later on, the decision makers may take a different approach to a customer who has been paying steadily and managing well up to that point. You may have contracts that you don't pay monthly, but quarterly, semi-annually, maybe annually, but you want to be able to pinch a little off the rest rather than debit your account in the month it's due. Savings can be useful even if your income is completely unpredictable. You know you will get it, but one way or another. This is typically the case for entrepreneurs, when it's a good idea to save, as a kind of reserve. In this case, your goal is not to earn a return, but specifically to be able to survive in the leaner months. But a leaner month may not only affect you as an entrepreneur, so part of the savings is to build up an emergency reserve. You may not use this at all for years, so it's not true for this one point that you can already see when it will be used. However, not being able to see it doesn't mean you can't plan for it. You cannot say that you will have some emergency in your life only 20 years from now. In the same way, you cannot say that tomorrow is not that day. The level of savings is affected by interest rates. The higher the interest rate, the more attractive it makes saving, as it is risk-free. Confidence is also a factor. And here I am talking primarily about confidence in the future. Low confidence levels can encourage households and businesses to save more, because who knows what the future will bring. What is not significantly affected is the income. At a certain income level, it is up to you to decide whether to use all your income or invest it. Let's look at investments now. An investment is the part of your money at which you buy something. Stocks, property, mutual funds, whatever, in the hope of making a profit. Investment in the economy should be defined as an addition to the capital stock. Just to flash a little, this is called gross fixed capital formation. For example, investment may include investment in factories or new capital. However, investment can be in more than just physical things. It also includes expenditure on human capital, for example, investment in training and education. In other words, anything that you buy because it will bring something back. If we stick very strictly to financial investment, know that money needs time to work and produce. Thus, it requires long-term thinking because of the solutions beyond the year. When do you need to invest? Well, you need it when you already have a stable emergency reserve. Without it, everything could collapse. You may also need it when your income is stable or at least predictable. But you may need an investment if you want to own a large item that is too much of a burden on your own resources. This could be owning your own property, a car, investing in your business, or even accumulating your own pension wealth. The level of investment is influenced by interest rates and confidence in the future in the same way, but with a different sign compared to savings. Higher interest rates make investment more expensive, reducing the appetite for investment. The cost of borrowing then increases, reducing the potential return. If firms and individuals are confident in stability, they are willing to invest. If the level of confidence is not sufficient, they will delay their decision. As a mass phenomenon, you saw this after the 2008 crisis, when for a long time the market had just sideways because no one dared to make a major move. Note that while in savings you are free to choose between keeping your money at home or in the bank, because you got almost the same result regardless of your choice, the situation is different for investments. Here you get a completely different result, even a different signed outcome, if you make a different decision. It's important to know when and how you want to use it, and also to know your own level of competence and risk tolerance. So it's good to align your different goals and plan your investment. We can help you with this. You can contact us using the link in the description. Let's summarize what we have been talking about so far. You put the savings aside to cover a future expense, for example, going on holiday with it, or in a good case, for a Christmas present to avoid the unnecessary loan. The risks of investing are typically taken for the sake of the returns that can be achieved, for example, some kind of yield. The higher the risk, the higher the expected return, but this is an expectation, not a guarantee. The higher the interest rate, the more people save and the less willing they are to invest. On the one hand, higher interest rates are not only affect the bank deposit side, but also on the loan side. So they make it more expensive to buy, or if you are thinking of buying shares in other companies, they can make it riskier. On the other hand, if a relatively high interest rate can be achieved without risk, the possibility of ever diminishing extra returns will be attractive to fewer people. The more confidence we have in the stability of the economy, the more willing we are to invest, and in the event of an emergency, or just on news of one, we are more likely to postpone this decision. There are some interesting questions I would like your views on in the comments. If you invest for profit, and when you save, it doesn't matter if you have a meaningful return, should you consider as an investment a move where you bet on the wrong horse and didn't gain anything from it, but you haven't lost either? What do you think of it if you might have got out at a loss, so you don't get all of your money back? In the midst of a crisis, the price of securities can fall, and if you buy them at the low price, you can sell them at a significant profit. So that's when your investment makes the most money. But during a crisis, confidence levels also hit rock bottom, which encourages people to save rather than invest. Do you think it's worth investing during a crisis, or is it better to build up a safety margin? Tell us why you think so. You can ask whether saving equals investing overall. Since the bank in its classic way of operating collects deposits and then lends it out to someone to make an investment, it should be equal. This is where the economist in me comes out, and as this may be a slightly more difficult subject, I have left it to the end. In neoclassical economics, it is assumed that the level of saving is equal to the level of investment. This is because investment is determined by the savings that can be made in the economy. As savings increase, people buy more securities and banks can lend more to businesses to finance investment projects. In a simple economic model, we can say that the level of savings is equal to the level of investment. This obviously does not hold at the level of individuals and households, but at the level of the economy as a whole it is a pretty good model.